Well, welcome everybody to another Pepperstone live session here on YouTube. I hope everyone's ready for today. It's going to be a great session. We're talking about everything to do with trading indices. And what a time to be trading indices, Tyrone. We're in the FOMC statement about to come out today, possibly a fairly historic 100 basis point hike in rates. About 25% of economists think that. And sure to be fireworks coming into Apple and Amazon's earnings as well, which will push around many indices throughout the world. So what a great time to be discussing the topic. How are you doing today, Ty?
Yeah, really good. Yeah, look, 100 points, surely not. I know it's a threat. It sounds terrifying, and look, it'll certainly start to move the indices around. But a lot of people don't realize this. If you haven't already, indices are some of the most technical trades that you can actually place, and it can be very, very easy to actually trade using the patterns that we talk about day in, day out. So really looking forward to getting it into this webinar and bringing you what we see literally on a daily basis.
Trading indices is one of my favorite things to do, Tyrone. So let's begin by just discussing what you're going to get out of today's session. If you're watching this in replay, of course, or live, remember to give it a thumbs up. We do appreciate if you appreciate the content as well. Let Pepperstone know you like this stuff. So we'll be covering a few topics. We'll be talking about how to day trade indices, some schematics, some concepts of basically figuring out zones that you're interested in and trying to stack the odds in your favor. That's what it's all about. Of course, we'll also be looking at some live chart technical analysis leading into this FOMC event. And we'll also be talking about key indicators on entry points, how we do it, the psychology of trading, and some of the things that you can possibly add to your system or potentially just for the first time learning about systems like this. We also have live Q&A. You can ask it anywhere or anytime. If you have a question, put it in the chat room. We really encourage that. And we'll either park it to the end, or of course, if it's a great question that goes with the flow, we'll answer it during the session. So feel free, guys, to really bring a question to the yard. If you have a question, I always say there's no dumb questions, Ty. Other people will be asking it as well. There's always somebody else out there that has the same question. So we talk about Wyckoff a little bit. And Wyckoff comes in when you're trying to talk about the psychology of a market. When you're trading indices, you've got to think, well, what is an indice or what is an index? It's basically a certain amount of companies with certain market capitalization sizes all together. The S&P 500 is the top 500 companies in the US. The ASX 200 here in Australia is the top 200 companies in Australia. And the FTSE 100 and the DAX 40 and all of these other indices, that's what they are. A lot of people don't look under the hood, Ty, and maybe they don't need to, but they also don't really understand necessarily what it is. I mean, most of you do, but some people don't. And therefore, why Wyckoff has this quote, successful tape reading is the study of force. It requires the ability to judge which side has the greatest pulling power, and one must have the courage to go with that side is so important, because what we're doing is we're trying to figure out with the S&P 500, where is the 500 companies going? Are they going up or are they going down? Of course, that sounds easy, but that's what we're trying to figure out. And that's one of the big things here. In terms of what pairs to start with, we're going to focus on indices today, but just remember, if you're going for gold, often in metals, gold's the best place to start. Gold US dollar, gold odd, gold euro, those types of things. US dollar majors, always good to start with. A lot of people to get into that with Forex. And of course, Pepperstone's an amazing Forex broker. So we have so many pairs. And then we have the major crosses and what we're talking about today, which is the indices. The S&P 500, the NASDAQ, Russell, DAX, FTSE, ASX 200. Ty, which one's your favorite?
At the moment, 2022, it's the Russell. I love the Russell. I think it's actually been the leading indicator for the world indices. And for those of you who don't know, the Russell is actually 2,000 companies, so American companies, and very, very important. I mean, look, the important thing about that is, it's taking I guess the average of 2,000 companies instead of 500. Now, yes, are they small caps? Are they mid caps? They're all over the place. But I think that gives us a better understanding of what's actually happening in the economy from a broader perspective. So, you're really getting a very, very big snapshot of what's actually happening. And I believe this year it's been a really good leading indicator to what has actually happened on the other major indices. So I think it's probably my favorite. But in the ASX 200 is always a favorite of ours. Of course, we look at that every day and trade it effectively every day. And you can't really go past the S&P. And look, even to a lesser extent, the FTSE is always good trading as well. All very, very technical, as you're certainly about to see.
Yeah, so we'll look at a few different pairs today and we'll go through some of the indices as we cover off on it. But before we do that, we also need to figure out which time frame is best for you. So remember, depending on which index you choose, maybe different time frames are better. If you're in Europe, it could potentially be that you want to look at the IWM, as you said, the S&P 500, the DAX, the FTSE. If you're in the Asian session, maybe you want to look at the Hong Kong market, maybe the ASX 200, and still, of course, you always want to be watching the S&P 500, but realistically, they might be better for your day trading techniques. So understand the time frame that's best for you, and of course, the type of pairs that often happen. Now, I particularly love the London session into the US session, Ty. I think that the opening of the US session from around 7 a.m. at New York time to around 11 a.m. at New York time is one of the best trading sessions you can get. This takes you from the pre-open in the US all the way into the open and a few hours in. Usually, if you are trading indices, this is the time to find the structure, especially the S&P 500 and Russell.
Most definitely. If you're at a party and the police are arriving, you know the party's really heating up then, and that party and the police are definitely going to be arriving between the New York session and the London session when they're crossing over. No question about that. Because there's volume. There's volume of two extraordinarily large economies, worldwide that are pushing and really, I guess, interacting with each other to an extent. But sometimes, and you will witness it, sometimes you see it in currency pairs, but it happens on the indices as well, where you get a little bit of a tug of war actually as to which one is going to dominate the session. And realistically, as traders, if we're going to day trade and we're going to look for small positions, we need volume, we need liquidity, and most importantly, we need volatility to actually move the market. And the market is never more volatile than in between those hours.
So that brings us to scalping and volatility, Ty, and what a great place to start with a schematic or like a process that you can apply. And obviously there's a few things we'll be going through today, but this is one of a few schematics. And the general concept is, of course, how do we find a bit of an end of a trend? So in these cases, what we have is, of course, we have down, there's a trough, lower peak, lower trough, lower peak, lower trough, lower peak. And then suddenly we make a lower trough and then we breach past lower peak. Now, it depends whether you're a supply demand type trader or you're a support resistant type trader. But really, what I like to do, Ty, is I like to take the learnings of many different types of trading techniques and see if we can apply them over a similar zone. It's kind of like what we do with Fibonacci. If you have two legs, let's say you've got a movement here and you've got a movement here, and for some reason a fib level is showing at the same level or the same zone, that can be incredibly powerful. It can show us a zone that may have even more confluence or ability for us to have a higher statistical chance of being successful. So when we breach past this lower peak here, this is a sequence that's very important to learn. It's part and parcel of really being successful in scalping and understanding when things are turning. And once you know that, then things like pullbacks become much easier. We have a bit of a mantra here at FX Evolution. The way that we think about it is patience, react, don't predict. And what that means is that you wait for the market to show you that it's changing trend. And when it shows you that it's changing trend, you want to go with effectively the money flow. Because if we can enter with the money flow, are we not usually adding to our statistics? Of course, that's what we want to be doing. Going with the algorithm, going with the big money. What we don't want to be doing is following the retail herd. Often we make the poorer decisions, and you'll find that when you start to recognize scalping sequences and especially directional changes, often everyone in retail is thinking the opposite of what you're thinking. And when that happens, sometimes you have one of those aha moments, I call it, Ty, a big idea.
Yeah. It's almost funny how the retail herd seems to want to do the opposite of what's actually happening with momentum. And it's actually quite uncanny. So you need to put yourself where the money's actually going, not where you want it to go. That's the whole idea, really, isn't it? Like, we need to be actually able to identify where the real money flow is. And you want to be going in that direction. People make the mistake of thinking that they need to be trading with an edge against the market. The true edge of the market is to actually know where the real money is. And knowing that and trading with that is always going to set you on the right path. That's I think that's trading 101, and it probably sounds a little bit obvious, but you would be amazed. I couldn't put a percentage on it, but it would be extraordinarily high as to how many people that we talk to all the time don't actually do that in the first instance.
So when these basically what we call first time frame trend changes happen, they become very important for the scalper. So here we have the lower peak being broken by a new peak, basically a higher peak. Here we have a lower trough being breached by a new lower trough. When these types of things occur, it tells the scalper that something's happening, something's changed in this market. And when you can bring that together with other areas, and we'll talk about maybe a simple strategy you can use today to add on to your already existing strategies, it becomes a point where you say, I see what they're doing. And then you can start to become patient and wait for the next entry point. Effectively, you're kind of doing a sequence kind of like this, where you want to be here or you want to be here. And this is where the game changes from a trading perspective, especially on indices. You need to understand that markets will generally come back to grab positions. There's another sequence here. We don't have time to cover everything today, but if you are interested, you can always contact us about more things. But basically, there's the sequence is always, think of it this way. We want to breach these lower peaks, and in this case, we want to breach those lower troughs. This is where many times the orders hide, and the orders hide behind these levels. Once they are taken, we have to think of it like a squeeze. So the market is breaking through, squeezing the position, pulling back, and then going in its direction. And that's kind of what Wyckoff was saying. Wyckoff was saying, hey, if we can figure out the direction or the force of the market, the demand of the market or the supply of the market, then we can have a much better idea of the next move in terms of what's going on. If you have any questions, feel free to ask as well throughout today's session. We will get into the charts very soon and show some of these. So these are the two kind of concepts that Wyckoff had. He had the accumulation and the distribution. I'll just remove us from the screen for a second, Ty, so everyone can see this. So we have here the accumulation area down the bottom left-hand side. The idea is that hopefully we'd have some type of sequence coming into this, like this type of thing, or even in the lows, and then it would do something like this. And effectively, this would be an accumulation area. The bigger players would position themselves with buying it, and then it would break out. And of course, we want to be in that breakout to go into the markup phase. This is where most of retail kind of find out about an idea. And unfortunately for retail, Ty, we usually find out about it around here, become convinced by the idea around here, and then all of a sudden it goes into distribution and goes the opposite way. It's funny how that happens. It's kind of like the US dollar recently. Everyone's been talking about how great the US dollar is, but at the moment, is it that great? It's starting to show a little bit of weakness, isn't it?
Yeah, it's that same crowd that was thinking that Bitcoin was super, buying it at 70,000, I think.
Yeah, an extreme case of it.
Yeah, same thing. And you generally see that it happens a lot, actually. And you know what? I think the big money relies on it, actually. So realistically, you've got to be very, very aware and know that that's what's happening. So, and when you do become aware of it, I think you'll be surprised at how easy it is to spot in the market. And we will look at the chart shortly, but it is very, very easy to spot when you do know what you're looking for. I think that's really the important part there.
So here's the theory, or the Dow Theory Concept. And again, it was very similar to Wyckoff's concept. We had an accumulation, which was the phase one of a market move. We had the participation, which was the markup phase effectively. And then we had the excess phase. So another great way of thinking about this in indices, or just in terms of sectors at the moment in markets, would be energy. Everyone thought energy was the best. Then they got very convinced by it. And then all of a sudden it crashed about 30% plus only in 2-3 weeks. So that's what happened to energy only a month ago. Basically, it crashed 30% while everyone was becoming very bullish against it. So this is the type of thing that you want to be part of. We ideally, whether we're scalping, whether we're day trading, whether we're investing, it doesn't matter. We want to be in the public participation of the move, or at least at the beginning of the public participation. And ideally, we want to get out just before the excess. Effectively, take 2/3 of the move would be a smiley face kind of idea for us, Ty.
Yeah.
I would be pretty happy if I got 2/3 of the move all the time. I'm sure many of you would. So how do we do that? Well, of course, we understand the theory of trend, and we understand trends and how they work. The real concept of being successful as a scalper is actually to use something that we've never deviated from for, I would say, 12, 13 years now, ever since we really realized to use multi-time frames. We began scalping and day trading, and like many of you out there, how did we do it? We kind of followed like a 1 minute, 5 minute, 15 minute. Now, I'm not saying that they are bad timeframes. They're absolutely not. But what we weren't doing is we weren't paying enough, or we just didn't pay enough attention to the 1 hour daily, did we, Ty?
Not at all. Stochastic crossover in the overbought or oversold, buy or sell, and that was it.
Like that.
Multi-time frame analysis was something that we had no idea about, but by golly, when we did work out that was a very important part of trading, it made an extraordinary difference. And to this day, it's everything that we do. And for all of you who follow us regularly, you know that we always break down the charts from the tallest time frames all the way down to the smallest. And there's a very, very good reason for that. And look, when you do understand that the prevailing trend is the most important trend, that's what really unlocks the idea that you can really identify these mini movements. And look, a daily move is a mini move on a monthly chart, and just like a 5 minute move on a daily or a 4 hour chart is a mini move. But if they're at a very important levels that you can only identify using multi-time frame analysis, that's where the secret is.
So what I want to do is I want to bring us all into a concept here. And that concept is we follow a trend, and we found a trend. The trend is up. The daily trend is up. Fantastic. Well done. We've done well. We now know that it's coming up. The thing is, it's pulling back. And it pulls back and it hits the previous peak. And at that point, we see the schematic, the one from only a few slides ago. Would we have, and I ask you this question, a higher statistical chance of success considering we're in the direction of the daily trend and that we have found a scalp or day trade at a key level? The answer is generally yes, because what we're doing is we're starting to stack the odds in our favor. Now, it's not just as simple as this, and we'll look at some examples here in the markets very soon, but it's what you've got to start thinking about in markets. You've got to start thinking about, well, if we're in a directional trend, whether it's up or it's down, and we can spot that, we'd be better off going in the direction, but why can't we scalp in that direction? Or why can't we look for the smaller opportunities so that the larger time frames will push in our direction? And it's what some people fail to recognize. They always want to counter trend. They always want to say, oh, I'm going to counter, I'm going to counter, I'm going to counter. That's fine. But of course, risk management is key, and you won't get as bigger risk rewards. Now, most of you out there, of course, you're saying, okay, well, I at least want 1-to-1. That is, you risk $100 and you make $100. Okay, that's okay. But to get the bigger ones, to get those kind of 10-to-1 style returns where you risk $100 and you make $1,000, and of course you could risk $1,000 and make $10,000, the way that you get these bigger ones is by stacking the odds in your favor. And that's why you want to use separate concepts that all kind of interlink and interconnect together, and then have really the mantra again that we're talking about here, which is patience, and then react, don't predict. So say today we're coming into the FOMC. We're coming into potentially, well, pretty much 75 basis points, probably potentially 100. We don't know. So that's a big interest rate hike. And we don't know what's going on. I mean, would you know where the market's going to move into the FOMC? It's probably unlikely you have a clear direction of what's going on. So you've got to ask yourself the question, well, would I be better off trading before this news? Or would I be better off trading, reacting past the news, seeing the initial reaction? Usually the first one or the first direction is often wrong, by the way. I see Gary in the chat. Gary, let everyone know, what do you think about the first reaction in markets after news? And then the counter argument, because often markets will go to get liquidity. Now, there are trades around, or there are opportunities and indices to look for liquidity, and we can potentially discuss that for today. But the other thing is then to see the real move. And once it starts moving, it usually goes and it will have a pullback, which will allow scalpers and day traders generally to get back in. So they'll be able to get in there. And that's when you're starting to stack that probability in your favor. Trading news is cool on the surface, but you've got to have incredible discipline. So sometimes it's better to have the patience to say, well, are things clear to me? If they're not clear, maybe don't take them. Focus on your risk reward, focus on those types of things. So another example of a market would be going up like this, Tyrone. The market comes down and then the market starts channeling and the market breaks out. Structure is formed, channel. Now in this direction, usually a channel would be A equals B, wouldn't it? So the direction would go up and you would buy it out of here.
Yep.
But what if this was in the direction of a larger time frame trend? Could you leave some on?
Oh, yeah. Yeah, you must.
There's the official answer, guys.
You must.
Yeah.
You must. And I think that's what brings us to the major point that we're trying to explain. If you know that channel is part of a bigger plan, and you've got your multiple time frame analysis happening, and you know that you're in the direction of a trend, and that channel is just merely consolidation zone of accumulation and distribution before the next move up, there's really no reason to be taking all of your potential profit just from that standard, because you know that the bigger move, the bigger prevailing move, is going to give you a significantly larger potential profit from effectively the same stop loss. And I think that's where you start to see your 4, 5, 6 to 1 trades where you know you're doing a happy dance when you get one of those. But when you identify it and you see that the prevailing trend is actually doing that for you, a lot of the work, the market is doing the work for you. All you have to do is actually participate. And I think that's why it's so important to understand, is a channel really a channel, or is a channel part of a bigger plan that's actually going into the direction that you want? So hopefully, look, this is an intermediate webinar, but if you have any questions, please feel free to ask. If you have any questions on what we've talked about and potentially what we're about to talk about, put it in there and we'll answer it while we go, if it's relevant to what we're looking at, or we'll do it at the end. Ask us anything. Is Tom using a pen to actually draw on the charts, or is he actually using his cursor on his mouth? I'm not sure. I might have to ask that question in the chat myself, because I am always I am amazed at the ability to be able to write like I'm writing with a pen, and he does that with his cursor. So ask away.
So here's an example of a market that's been moving up. This is the S&P, the NASDAQ in this case. So I'll actually switch over to the S&P 500 here quickly. And the reason I wanted to go there was because the S&P 500 often gives you the best technical entries. So here we have a horizontal line, and I think this is very important to focus in on. We had the previous kind of peak, and we breached that peak. And then you'll notice I boxed a little zone down here for today. This only happened a few days ago. It wasn't long ago. And the market came down and it hit a key level. It hit this 39, kind of 18, 20 zone. Now, that was the previous high. It was the first time we'd pulled back after, obviously, moving up. And for a scalper, they're going to come into this and they're going to say, well, wait a second. Am I interested in this area? Am I interested between here and possibly that high? Basically boxing a zone between this high and this high. This area, a point of interest. So what could a trader do? Let's say you were a scalper and you're a day trader and you're thinking about trading indices and you want to go in the direction of trend. Well, this would be a good area to set an alert. So maybe it's worthwhile setting an alert for somewhere around here. Of course, then focusing in once the alert goes off and recognizing a potential setup. And if it just so happens between the times of 7 a.m. and 11 a.m. New York time, then that would be even more fantastic, because what happens around that period? Liquidity. So that's when you start to see a huge amount of orders coming into the system. So you probably know it's more likely to be a real move. So as you then zoom in on it, you'll notice that we go down, we come up, we go down, make a new low, we come up and breach it, then we pull back a little bit and we go for a slingshot movement. It's this movement here that you're interested in. Remember back to that first little section, the schematic, the concept. It's very important to understand these types of things, because if we see them and we see them play out in zones of interest, then they're probably stacking the odds in our favor. And that's what really today is about. Indices are generally bullish mechanisms. Okay, we need to understand that. It's a little bit different to Forex. In Forex, you're trading a floating currency. The currency could go up, the currency could go down. Obviously, it doesn't really have a perceived fair value, okay? And what that means is that central banks and all different bits of fundamental news can switch it. Whereas a index is 500 companies employing millions, probably, of employees to try to make more money. I mean, that's in essence what it is, isn't it, Ty? They are trying to make money. So should it technically go up? Technically, yes.
Yes. And look, you've got to look at it another way as well. When you look at a currency pair, there's a million moving parts that make it either go up or go down or just move sideways. And it's impossible to know, unless you're Chris Weston, it's impossible to know all of those moving parts and what actually makes them move. So when you're looking at an indice, you're there's two things that I really like about them. One, apart from the fact that they're very technical because you are right, Tom. I mean, for the most part, they are really designed to eventually go long in the long run, but they also can't be bullied. You can't bully 500 companies. You can't manipulate 500 companies, especially the biggest 500 companies in the US, right? So you're dealing with an economy that actually makes a little bit more sense. So I think, and there was a question in the room about fundamentals. Do fundamentals affect technical analysis? Look, fundamentals are more difficult to trade, in our opinion, mainly because of the timing, right? It's not the fundamentals don't work. Of course they work, but they're very, very difficult to time. So technical analysis gives you the added advantage of not only understanding where something potentially should be, but also when it should be there and how long it's going to take. Our idea on fundamental analysis is when we can combine the fundamental and technical analysis approach and they actually sync, it's a beautiful, beautiful thing. It's like poetry. And, I know Thomas loves his poetry, and I often see him cry when he's having a beautiful poem read to him by his lovely wife. And that's all good and well. That's what's happening when fundamental analysis and technical analysis are in perfect sync with each other. Can they sometimes contradict each other? Absolutely, they can. But that, again, it comes down to what sort of a trader you are, right? So if you are a long-term investor, fundamentals are going to take a lot more influence on decisions you potentially could make. But you know what? If you're a day trader or a scalper and you're only looking for short and sharp moves in a particular session, fundamentals play a lot less involvement in your decision-making process. So they really come to play in the or depending on what sort of a trader you are. So you just got to be really mindful as to what you're trying to achieve. And that's where the fundamentals will come into it. They are very, very important. And sometimes they agree with technical, sometimes they don't. But if they don't, there's generally a reason. And I think most of that it comes down to actual multi-time frame analysis is generally the reason for the disagreement or the perceived disagreement.
So we got a question coming in here from Zodiac. What if the big picture shows we're in an uptrend, but it's already been going on for a while and it is overbought? Would you still trade in the direction of trend? Well, the question becomes is, have you actually seen a sign that tells you that it's over? See, here's the thing. There's a great quote. Markets can stay, let's say, irrational longer than you can remain solvent. There were great traders back in the 1990s, 1998. Many people thought the US market was overpriced. They were correct. But there's a famous one. You can look it up. I can't remember the exact guy's name. Famous hedge fund manager. The guy was betting big against the market to explosion. He got cut up, as in he basically lost his position short about a month before it crashed. And he knew that it was overpriced and he tried all he could and he had to eventually just give in because he was getting crushed. And that's the thing. He was trying to go against the trend. Markets can stay irrational longer than you can remain solvent. Probably 2020 into 2021 for many people was that lesson. So if you're not seeing the signs of turnaround, e.g. these types of signs, why would you fight it?
Yeah. The Big Short. Watch the movie The Big Short, guys. And you'll have a bit of an explanation. Although Christian Bale did get, he was able to sustain the move, but basically everybody fell apart. Everybody knew that it was overpriced. They all fought it, and most people couldn't actually survive until it actually did eventually go on to the job. So you don't want to be in that. Look, we are very, very, very big on trading what we see and not what we anticipate. It's really that. Patience, react, and don't predict. It's an extraordinarily important, little saying, and it's front and center on the chart for a reason because it is very, very important. The market will do what it's going to do. We need to work back to what we were saying earlier. You work with the market, not against it. And part of that process is, although something's is potentially at a very, very heavily overbought level, that's what brings, ironically. It's that brings so many novice traders undone when they are trading the exact same thing that Thomas and I used to play around with probably nearly 15 years ago now, when you're trading stochastic crossovers. Like, they work great in sideways markets until they don't. And then you try to fight the overbought levels or the oversold levels. Go back and have a look at how long something can stay overbought and oversold on an indicator, and you'll be very, very mindful that that is not the case. And they work great when the market conditions are correct. And this is exactly what we're talking about, identifying the market conditions that are playing the game for what you're trying to achieve. And when they do, it makes a very, very big difference to understanding a level. So understanding that overbought level, understanding that that it may well be very heavily overbought or very heavily oversold. It doesn't mean that you just go all in the opposite direction. It means that you trade with a lot more caution in the direction that it is overbought or oversold, and be prepared and ready to actually react when it actually does move, rather than trying to actually recoup all the losses you made trying to actually go in the opposite direction.
So here's a question I'm going to ask everyone. And well, actually, I should have gone back to another point where you couldn't see it. But basically, what I want to look at here is think about the market as it's going up. It's going up and it's making a series of new peaks and higher troughs and higher peaks. And it comes down to this point here, 39.75. The previous trough, the previous low before it made a new peak. Think back to what we talked about at the beginning of today's session. And we breach and we close underneath. What does that do? And I want to ask this to everybody here that's live in the chat. What does that do? What do you think that's telling us about this market? Remember, we've gone to a peak. We've made a higher trough. And then we've made a higher peak. And then something has happened here. So what, in essence, is this telling us on this particular time frame at this particular time? And it comes almost to Zodiac's question in terms of, would you be bullish or would you be bearish? What are you going to be here? Does anyone know? I'm going to give him 30 seconds, Ty, and then we'll keep going. But what I want to mention while we wait for that is, of course, today's FOMC. So remember, everybody, that it's not just FOMC at the moment for these indices. The US market controls, in many ways, pretty much all the indices to a degree. Whether you trade the ASX or you trade the DAX or you trade the FTSE, the problem is going to always be that the US market, if it's down, will usually drag the other markets with it. So today's announcement, and therefore US news in general, is incredibly important for you to look at if you are a scalper or day trader or index player. That is somebody that wants to trade these markets. If you're not aware of the news coming out, make sure you get an economic calendar. And if you don't know, let's say, what's going to happen, here it is. Don't trade until you become more aware of your surroundings and more aware, more confident in your position. So that's really important. I was doing some training with a few people recently, Ty, in the mentoring classes we do. And I said that to them. I said, if you're not sure and you're confused, why put your hard-earned money into that? Wait until you are less confused and then make your decision. So we've got chat coming in all over the place here. We've got people going all over the place. So it's beginning to change. That's correct. So this would be the change of basically the trend. We would be seeing the change here, and we would then be looking towards the short, at least on this particular time frame. Now, would that be as strong as the longs? No, because it's against potentially the higher time frames. Remember, it's only the 15-minute that we're seeing this change of trend. So therefore, you would, when you're taking, let's say, shorts, or you're thinking about shorting positions, etc., the way you've got to look at it is maybe less risk or less reward. That is, if you usually were taking a huge position and you were waiting for it to move a large amount, you might instead say, well, I don't know it's going to move that much. So taking the available information you had here, let's say you did short this area, where would you take profit? Somewhere in here would be your take profit zone, because you're going counter to the larger, higher time frame trend. It's very important to delineate that, because some people say they want a counter trend all the time. Well, yes, this is technically a counter trend to the higher ones. Yes, there is good trades in here and here, but because you have available information at this point, you want to go probably somewhere around there. So good work, everyone that said that.
Very important to understand that when you are counter trending, you understand the levels. I think that's probably the most important thing. Some people, the problem with counter trending, and I think this is probably the biggest knock on it, is that a lot of people who actually counter trend don't actually realize that they are counter trending. And I think that's probably the biggest problem for them, because there isn't anything technically wrong with counter trending when you know what you're doing and you understand the levels. It's actually just, it is a process of what we do. But you have to know that you are counter trending. If you don't know that you are counter trending, you don't know where to be looking for your correct take profit zones. And correct take profit zones can be just as important as the correct stop loss levels, because Otherwise, what it's going to do is going to lead you on a foolhardy expedition to take a market where it's not going to go, or expecting it to go where it's not going to go. So it's very, very important to understand that if you are counter trending, you know that you are counter trending. And I think, again, sometimes I hear things come out of my mouth and I say, well, that sounds so obvious, Ty. But it's amazing that these are the things that bring traders undone, because they don't actually realize what's actually happening in the bigger picture. And when you do understand that, it really gives you a massive advantage. So it's very, very important to do. And probably what I like about it too, Tom, is it's actually so simple. Multi-time frame analysis is actually very, very easy. But you know what? It takes an effort. And effort is where a lot of traders actually lack the discipline to put that effort in. And rather than actually looking at it and checking it, it's not a hard process. We're not talking about a massive scientific breakthrough here where multi-time frame analysis is going to be the golden goose. It's a very, very simple process of just working through the time frames and understanding where the real money is, where the real trend is, and just as importantly, where the real levels are.
Yeah, labeling things like daily closes, tie on your charts, labeling things like the different time frames, and understanding that really just because you look at 1 hour, 4 hour, of course, there's still a 2 hour, 3 hour. Are they also in the direction? All of these things do require an effort. And I think it's kind of like one of Wyckoff's rules, which was about effort. And he said that when effort was certainly, basically when effort continued, let's say an accumulation area, it could mean big things. So in this case, it's the effort of putting in the work and doing a little bit of extra work. If you don't set alerts, if you're not patient and disciplined, you probably will fail. I mean, it's the reality, unfortunately. This is a brutal game if you don't have the discipline. Here's a question coming in about discipline. It says, well, not so much discipline, but another couple of things here, how do you protect your trade idea from economic news? Very often I identify a good level for entry, set stop losses, set levels, and scale out. So all of those things are great things to do. Set the stop loss, set the level, set the scale out. How do you protect it from economic news? Well, the thing is that, again, this comes back to trading with trend. Oftentimes, you'll find the prevailing trend is benefited by the economic news. Now, if you're scalping or day trading, your stop loss, unfortunately, may be too tight. That is, it might be in an area that's just too dangerous to take it into the economic news. Let's say, for example, here, you were thinking about buying the US 500 and you thought, oh, I like this level. Let's say you placed a stop loss below here. Well, of course, the chances of you holding that order through the economic news today are incredibly low. If you put it here, they're still probably quite low. If you have a stop loss below here, they become, let's say, higher or relatively high. So it just really depends on where your stop loss is in relative terms to the current price. If the current price is in the middle, oftentimes during most economic events, it won't push the market as much. Remember, it's the S&P 500. It's hard to push it 3-4%. So if you're 1% away or 0.75% of the way away, you're probably usually far enough away. Today is a very extreme case. The FOMC statement today, it's one of those, especially with Apple and Amazon coming in with next session, and we've still got Spotify, I believe, and Shop and all of these other big stocks announcing. This is earnings and a massive news announcement. These are ones where, for many traders that aren't used to it, it could be a point where you have to just wait for the economic news to come out. But generally speaking, you want to put them behind big amounts of wicks. And when you find a lot of wicks, having your stop losses behind heaps of wicks can be very good.
Yeah, most definitely. We have another question there coming in from Mike about what is a counter trend. It might be easier to actually show that rather than actually explain it, but it's effectively trading against the prevailing trend, Mike. So yeah, if you have a look at a series of higher highs and higher lows, what you're effectively doing is you're trading the pullback. So you can see that we're obviously making a series of higher highs and higher lows, and then we're making lower highs and lower lows. What you're effectively doing is actually trading against that bigger prevailing trend. So it's really going against the big flow, if you like. It's not that it's not profitable. It can be, but you just have to understand that if you are trading in the direction of or against the direction of the prevailing trend, which is a bigger time frame trend, those moves are going to be short-lived and sharp. So that's why you have to be very, very mindful that you are doing it and you understand where those levels are.
So we've got another question. I think these are all very relevant. Of course, today it's going to be tough for us to say, oh, we love this level or we don't love this level. And I'll explain why. If you add an indicator such as volume profile, which you can do here with Pepperstone and obviously the TradingView platform, you can add in, let's say, visible range on the volume profile. And I'll just switch this over settings to the left-hand side so everyone can see it. And notice with our volume profile, where is price? It's sitting where all of the orders have been placed before. This is kind of showing us where there's a ton of confluence. Like it's a big zone, huge zone. So heading into the FOMC, where are we? We're sitting right on it. So basically we're at what you could all call is almost neutral. And that's why it's very tough for us to say, oh, we love this level or not. I mean, of course, I have some highlighted box zones here that we've brought up. But yeah, that's really the big crux of it there. So the question here is, where is it here? For a day trader, what time frame should one look at? So I think for index trading, you do want to know the daily high and lows. So you want to look at dailies and you would like to know the high, the low, that type of thing. Very important. The other thing that we want to do is we want to know the 4-hour time frame usually, or a 2-hour time frame. The 1 hour is incredibly important. That's usually where you can define kind of your medium short-term trend. And then 15 minutes into 5 minutes. And I don't even mind tick charts. Yeah, I said that, tick charts. But when you use tick charts, it's all about understanding the structure of the market. So I like all of these timeframes. Again, multi-time frame is the plan. If you were to say, which ones do I have? Which one, if you could only have a few, what would you choose? I would choose 1 hour, daily, 2 minute, and if I can only have 3, that'd be it. 2 or 3 minute, maybe 3 minute. Nah, 2 minute. We'll go with 2 minute. I like all those little low time frames as well. So if I had only 3, that's what I would probably do. I would still like the 15. I would still like the 4 hour, the 2 hour, etc. But these are as a good 3.
Yeah,
nice.
What I like about what I generally do, just on top of that as well, is work with time frames that often what you see is what the rest of the world sees, and I think that's really important. So when you see a 15-minute chart or a 1 hour chart, you're going to get the exact same market movement as here in Australia as we are in the US or in Europe or the UK, because an hour close is an hour close. Basically, the GMT doesn't actually make any difference. Sometimes 4-hour charts can be a little bit deceptive, because if you've got, say your broker has a different time close of a 4-hour candle, a 4-hour chart can look very, very different from one broker to another or one chart to another. So it can be a little bit confusing. And sometimes what we don't want in the market is confusion. But the good thing about hourly charts especially is an hour is an hour, and they close, on the hour all around the world. So that does make a big difference.
So far we've covered off a couple of pretty cool ideas. We obviously covered off the idea that you want to start to box zones. Now, how can we box zones? Of course, daily high lows, great way to start. If you're a day trader, you want to come in. Now, what kind of daily high lows do we want to use? Well, some people will say use the futures market. Often, though, the best market to use is actually to go over quickly to the real stock market, that is the S&P, during the open hours, and use its highs and lows. That is the low of the previous session and, of course, the high of the previous session. And that gives you a bit of a range to understand. And then you can go and look at those levels, look at the high, look at the low, look at the price around those. So you'll notice here that we had that 39 kind of 10 zone, the previous highs over here. Interesting. Exactly where we went with the real market, of course, not the futures market. Now, it doesn't mean you don't trade with the futures market. Of course, that's best because you have that flexibility. You can see more information. But these are incredibly important levels for a day trader. Oftentimes, when a daily high is taken out, it might have a bit of a spurt in it. Sometimes there are traps around there that you want to spot. There's all sorts of things. Often you'll have 2, let's say, daily lows that are equal with each other. And if you have this, what is that telling us? There's something going on here. So that could mean that it's bought once, it's bought twice. When it makes a new high, that could be the beginning of a serious movement, because it's, of course, respected this level. And that might be a level that you want to therefore have boxed up in the future, should the market come down the future, so that you can be going, okay, do I see some movement here that is looking positive? And that can be something that you add into your into your trading concepts. Volume profiles can be very helpful as well, by defining visible ranges or the range that you're looking at, getting a bit of an idea of where price likes to go. E.g. here, you can see the price really likes this level quite a lot, it seems. And again, something very important, gap ranges as well. 39.21 previous close. Current market is 39.50-ish at the time of this recording. So basically with the previous high. So what that means is the market is set to open above the previous day. So there's effectively a gap there. And gap trading can be very, very successful, can't it, Ty?
Oh, most definitely. I mean, we did a webinar on it. I think it was, you'll find it in the YouTube channels. We've been talking about it a little bit actually, because we have seen quite a bit of gap trading and island trading, we like to call it as well. And when it does happen on an index, it is actually a little bit more significant than when it happens on a very, I guess high risk stock that gaps quite often. When you see a gap on a serious, when you see a serious gap, it's generally far more important. If you see a gap on an S&P 500, it's a very important gap. So it's certainly something. Look, it's probably a story for another day that we've talked about.
For sure.
But they are, they're generally they're a trading system within themselves. Those islands that we're drawing up there, like they are a no nonsense trade there.
Yeah, it's a winner chicken dinner, as I like to call it, Ty. I like island trades. They're very difficult to find often in indices, but when you do find them, it's a big one. Another one that's interesting, just looking at the current market and the current, land, would be the DAX. The DAX here, if you look at the index at the moment, you'll notice I've got a little highlight here above this area. It's just Wickapalooza, as I call it, Ty. There's so many rejection weeks. I mean, it kind of paints a very bearish picture of this market right now. But what if the market was able to actually reverse and go bullish and get above these highs? I mean, this would be incredibly significant. And these are the things at stake today with the FOMC. I mean, yes, this is the DAX, but of course, if the market was going bullish and it broke through these previous highs, wouldn't that be incredibly significant? That would basically say that all of the orders trying to short here, and here were going to be squeezed. And many people are familiar with short squeezes. That's the type of thing you also look for in markets. So there's so many different things that you can do. Of course, today we covered off on the indices and we covered off on what an index is. Really, we had a look at a couple of schematics. We had an idea of maybe if you're following trends, possibly the pullbacks, you could be looking for, let's say, some kind of structural setup in the direction of pullbacks of trends. And then take that. Boxing. If you can box price, figure out a key zone, use multi-time frame trends, you are a huge part of the way towards really changing the way that you perceive markets. I think it's very important.
Very, very important. And it doesn't mean just drawing boxes everywhere, right? Like we're not just saying,
no.
Work with it. It's very important that you draw them in the right places.
Mm-hmm.
The boxes that you draw need to have a significant reason to be there, and that's why I think we like boxes more than we like key price levels, because realistically it's very, very difficult for a market to just land at a particular price and say, all right, this is the number. A zone is where you really want to be placing your boxes, because inside that box creates a whole world of opportunities in the different time frames. So, although these boxes look very, very small, there's a perfect example here on the NAS where you got your daily chart there. Those boxes look very, very small on a daily, but I can tell you, if you go down to a 15-minute chart or a 2-minute chart or a 5-minute chart, those are going to be able to create a whole different zone, and you're going to have a very, very different way of looking at that, because you can effectively trade the inside of that box many, many times over before it actually breaks out of that zone. So you're really opening up your horizon of how many trades you can actually place at different time frames. But the importance of those boxes is that you're highlighting the very, very key zones on the bigger time frame in the multiple time frame analysis method that we use. So when you do get down to the smaller ones, those boxes, just as an example, can we just pop down to a 5-minute chart, Tom, so we can see what that red box looks like, or any of those boxes actually, and you can see what a significant range they can actually be when price is actually trading inside it. I'll probably
for sure. This is 12,037 to like just under. That's 50-ish points.
Yeah. So, and that's a scalper's heaven. Like if you're in there and it's trading at a particular zone and you're trading a 1 or 2 minute chart, and you're trading, a really good volatile session, those edges of those boxes could be touched 5 or 6 times in an hour. And they're going to give you the opportunities. And as you can see, the ranges are far bigger than they look on the bigger time frame. But we do know that it's an important level, and we're basically going to be trying to trade inside that.
Yeah. Look, we've got some other great questions coming in here about key levels on the 5-minute and stuff. Well, I mean, to do with like key levels right now, I mean, maybe 12,300 a psych level. Obviously, a lot of wicks over here, pretty important. And that in itself is really a key zone to be looking at in these markets. If we breach that today, maybe that continues this bullish movement in terms of the longer time frame towards the next level up here. So there's like that free space zone, and a lot of scalpers, what you're looking for is you're saying, okay, if we breach this level, can we make it to the next level? And that's part of what it is. Some other good questions coming in here. Charles, tough question to answer quickly here. It's clear that you identify and mark the highs and the lows on the daily. Yep, that's certainly a good place to start. Could you show the other important levels marked in other timeframes? Probably take me a couple of hours to explain to you all the key levels and how you'd want to do it. I'd have to suggest looking at something like our courses or something. I mean, the reality is we can cover so much. Daily high lows, certainly very key to look at. Role reversal would be a concept I'd look into as well, where support becomes resistance or resistance becomes support. And then also thinking about the schematic. I mean, what you're doing is you're basically stacking reasons on top of each other. And when you find that, or weeks on top of each other, and when you find a lot of weeks or a lot of reasons, then usually you're finding a good level. Yeah.
Yeah, and the key, and probably the thing is there, price determines the level. You can't just set a level. Really, price is what actually determines those levels. And as you can see, I mean, as an example, right through that, even on that NAS 500 there, you can see all that sideways action. The more sideways action you're getting in a particular zone, that's identifying itself. Now, that could be a key number. It could be a key level, not necessarily related to a daily open or a close, or even a weekly open or a close. They are important, but quite often it's the price consolidation and the accumulation and distribution of a particular level that determines what that is actually going to do. And those zones effectively draw themselves. So it is very difficult to explain in a short time in a webinar, but they do make sense when you actually understand how the support and resistance zones do work. They kind of create themselves. And our job really as analysts is to actually identify the good ones and actually trade within the bounds of those until they actually break out in either direction. We always have one we favor, and that may well be in the direction of the prevailing trend, or it may be at a reversal and starting of a new prevailing trend. But really, when a big trend is actually changing, they're often the easiest to actually identify because you get a lot of trading opportunities inside that. Yes, you've got to be a little bit more cautious, but what you do often get is a lot more opportunities if you're actually trading smaller time frames and actually scalping inside those zones, because the moves start to get real. And then, of course, if you have predicted the trend and actually started to trade it actually as it does happen, then of course you're catching it very early, and it gives you a very big move, potentially to the next very, very key support level. And if that's on a daily or a weekly, sometimes that could equal hundreds and hundreds of points.
All right, Ty. Well, I think that brings us to the end. Thank you so much for your great questions today. We've covered indices. It's going to be an unclear point for the next couple of hours, most likely leading up to the FOMC. 100 basis points is, I think, the general speculation here. Here's a bit of a chart just to show you that most economists think 75% of cons think that we're going to get 75 basis points, and 25 think we're going to get 100. If it's not a surprise, then it probably will be a bit of a nothing event. If it is a surprise, and more importantly, the statement that comes after that, the statement's going to be the big one. If they start to say, well, the Fed probably should tell us nothing. I mean, I saw Ackman mention this, Ty. His big thing was that the Fed is not going to be very effective here with raising rates if the market continues to expect them to cut rates in 2023 to support the economy. And that's what the bond market is currently telling us. So here's the issue. The Fed really shouldn't be telling us what they're doing. They should, and Druckenmiller and other smart people have said that for years. The Fed should not post to the market what they're doing. That will create some serious volatility. Don't worry about that. But when you tell someone what you're going to do, it's not as effective, is it? Great idea.
No, that's right. It's almost like a threat of doing something, but not actually following through. And it does confuse. It does really confuse the market a little bit. I agree. I think that
I think it's pointless.
It's pointless. I think that their job is to actually do what needs to be done, and let the market sort that out after. I don't think we need. I think those statements can be. They can be more volatile in the event, actually.
Absolutely. The statement will be the one. They should just write like 3 dots.
Yeah.
And then just leave and then submit it and say, yeah, that's right. That's what we're doing.
or a little spinny wheel.
Yeah, little spin. Yeah. Like one of those like the hourglass on the original Windows or whatever.
All the way till next month when they have to do it again.
Yeah. Well, no, they shouldn't tell us anymore, because this needs to be effective. We're in serious inflation. So thanks so much for joining us. If you're interested in any of our courses or finding out more about our private community, etc., you can go over to www.fxevolution.com. As always, we'd love to thank Pepperstone for hosting us here and bringing this great content to you. Please give them feedback if you enjoy this stuff or you want to see more of any particular thing. Always let them know, and that helps us decide the next topic. And of course, give us a thumbs up if you enjoy the content and put some comments down below. Thanks so much, guys. We'll see you in a few weeks' time, and good luck trading the volatility over the next 48 hours. It's going to be a big one.
Thanks, everyone. See you soon.
Bye for now.